January 1st happened. China flipped the switch. The Ministry of Commerce announced what most assumed was policy theater. It was not. 60 to 70% of refined silver supply now flows through Beijing's licensing framework. Not a quota, not a guideline, a gate, and only 44 companies hold the keys. The rule is simple. If you want to export silver from China, you need minimum annual production capacity of 80 tons. You need state approval, you need compliance certification, you need credit lines thick enough to survive Beijing's scrutiny. Hundreds of smaller exporters just vanished from the market. The ones who supplied Europe's refineries, the ones who filled Japan's industrial orders, the ones who kept global supply chains liquid. They are gone. Ladies and gentlemen, Mark Yu here. Few understand what this mechanism actually creates. This is not about China restricting silver. This is about China controlling the flow valve for the entire industrial base of competing economies. Solar manufacturers in Germany, electronics assemblers in South Korea, EV battery producers across the American Southwest. They all assumed silver would remain available at market price. That assumption died on January 1st. The timing is surgical. For 5 consecutive years, global silver demand exceeded total supply, not by margins, by chasms. In 2025, demand hit 1.24 billion ounces. Total supply, including mine production and recycling, reached only 1.01 billion ounces, a deficit of 230 million ounces, equivalent to Mexico's entire annual output. Mexico is the world's largest silver producer. That deficit already existed before Beijing moved. Inventories were bleeding. Physical premiums were climbing. Industrial users were quietly panic buying, locking contracts months forward just to secure delivery. Then China announced it would restrict exports from the epicenter of global refining capacity. Not from a secondary player, from the processor, controlling 60 to 70% of refined silver globally. Let that settle. 60 to 70% under licensing control starting January 1st. Now, consider what silver actually does in the real economy. Each photovoltaic solar panel contains 15 to 25 grams of silver paste. There's no commercial substitute at scale. The solar industry alone consumed over 230 million ounces in 2025. By 2030, that number could hit 250 million ounces annually as installations accelerate globally. China controls most of that silver supply. China also dominates solar panel manufacturing. Beijing now decides which factories get metal and which ones starve. Electric vehicles require 25 to 50 grams of silver per unit. Battery electric vehicles use 67 to 79% more silver than internal combustion engines. The automotive industry's silver demand is growing at 3.4% annually through 2031. EV demand is expected to overtake traditional vehicles by 2027. Every car manufacturer outside China now faces a supply chain controlled by Beijing's export licensing regime. Data centers, AI servers, 5G infrastructure. These systems rely on silver's unmatched electrical conductivity for high-frequency signal transmission and thermal management. Silver-plated copper connectors prevent overheating in power delivery systems handling terawatt-scale loads. Global data center electricity consumption is approaching 1,000 terawatt-hours annually by 2026. That represents 3 to 5% of total global electricity demand. All of it requires silver-intensive components. Components now gated by Chinese export approvals. Industrial fabrication demand reached 680.5 million ounces in 2024. A record. That number climbed further in 2025. These are not speculative investors. These are manufacturers who need physical metal to keep production lines running. When they cannot source silver, assembly stops. Products do not ship. Revenue collapses. The world was already facing a structural deficit. China's move transformed that deficit into a strategic choke point. Some observers claim this is about environmental compliance. State media framed the restrictions as necessary to elevate silver from an ordinary commodity to a strategic material. That framing is accurate. It is strategic, but not for environmental reasons. This mirrors exactly what Beijing did with rare earth elements starting in 2000. Export quotas tightened gradually, licensing requirements expanded, prices spiked, industries dependent on Chinese rare earths faced supply crises. Some relocated, most paid higher prices. All of them learned that resource dependency creates geopolitical leverage. Silver is following the same playbook. Tungsten export restrictions launched simultaneously with silver. So did antimony controls. These 3 metals share strategic importance in defense applications, renewable energy infrastructure, and advanced manufacturing. The timing is not coincidence. This is coordinated resource diplomacy targeting sectors central to the global energy transition and technological competition. The licensing framework allows graduated escalation. Beijing can reduce quotas further without changing the underlying policy. It can tighten approval criteria. It can delay processing times. It can prioritize domestic consumption during periods of heightened tension. The structure is designed for flexibility, maximum leverage with plausible deniability. Western governments noticed. The United States designated silver as a critical mineral in November 2025. That classification acknowledges strategic vulnerability. It does not solve it. Domestic silver mining exists, but nowhere near sufficient scale. Recycling provides roughly 200 million ounces annually from jewelry, electronics, and industrial scrap. But solar panels installed over the past decade have not yet reached end of life. That recycled supply will not arrive until the 2040 timeframe. The gap cannot be filled quickly. Industrial buyers are responding the only way they can. They are bidding up physical metal. Lease rates for silver spiked above 5% in September 2025. Fifth time that year. Historical norms hovered near zero. 5% lease rates signaled genuine scarcity. Holders of physical bullion are demanding premiums to release inventory because they know replacement supply is constrained. That premium reflects real market stress, not speculation. London silver vaults saw notable drawdowns throughout 2025 as metal flowed to India and Asia. Exchange inventories are falling. COMEX warehouse stocks are under pressure. These are not abstract numbers on balance sheets. These are tons of physical metal leaving Western vaults and moving east, where industrial demand is insatiable and Beijing controls the refining infrastructure. China exported over 4,600 tons of silver in the first 11 months of 2025. It imported only 220 tons during that same period, a 21-to-1 export-to-import ratio. China is a massive net exporter of refined silver. That is the supply line now under licensing control. When those 4,600 tons get restricted, even partially, global supply chains fracture. Elon Musk commented publicly on the restrictions. He said silver is needed in many industrial processes and called the policy not good. Musk understands Tesla's supply chain. Every Tesla vehicle contains silver, battery management systems, power electronics, charging infrastructure, electrical contacts, all silver intensive. If Chinese export licenses tighten further, Tesla's production costs rise. Or worse, production slows waiting for metal. The solar industry faces acute risk, not because panels suddenly require more silver, because the silver they already require might not be available at any price. Analysts project that by 2030, solar demand could consume 10,000 to 14,000 tons annually. That represents 29 to 41% of total global silver supply. One industry consuming nearly half of a critical mineral. If China restricts exports to prioritize domestic solar manufacturing, the rest of the world faces a bidding war for scraps. Silver prices responded. They surged 100% in 2025, from around $30 per ounce at the start of the year to over $65 by December. Some analysts see $70 to $80 as baseline for 2026. Others cite supply-demand fundamentals pointing toward $100. A few project scenarios where prices reach triple digits if supply shocks intensify or financial conditions shift sharply. But price alone does not capture the mechanism. This is not a commodity rally driven by investor speculation. This is a supply chain breakdown driven by geopolitical control. When China limits export licenses, physical metal becomes unavailable regardless of price. Manufacturers cannot substitute. They cannot pivot quickly to alternative materials. Silver's electrical conductivity is unmatched. Its thermal properties are essential. Its reliability in high-performance applications has no commercial equal at scale. Industries now face a choice: accept higher costs and uncertain supply from Chinese licensed exporters, or attempt to rebuild supply chains outside China's control. The second option requires years and billions in capital investment. New mines take 5 to 10 years from discovery to production. Refining infrastructure cannot be constructed overnight. Even if every silver deposit outside China began development immediately, supply would not arrive until the early 2030s. Meanwhile, demand is not waiting. Solar installations are accelerating under climate mandates globally. EV adoption is policy-driven in Europe and North America. Data center build-out is exploding with AI compute requirements. These are not discretionary growth sectors. These are structural economic shifts with government backing and multi-trillion-dollar capital commitments. They all require silver. They all now depend on Beijing's licensing decisions. Some strategists argue markets will adapt. They point to technological innovation, thrifting techniques that reduce silver content in solar cells, alternative metallization methods, copper substitutes for certain applications. These developments are real. They are also insufficient. Thrifting reduces silver use per panel by small percentages. It does not eliminate dependency. Copper cannot match silver's conductivity in high-frequency applications. Alternatives work in narrow use cases, but fail at scale. The optimistic case assumes gradual adjustment. Prices rise modestly. Demand destruction occurs slowly through efficiency gains. Supply diversifies over years as new mines open and recycling improves. China maintains export flows at reduced but stable levels. Industries absorb higher costs and continue operating. That optimistic case ignores the leverage mechanism. Beijing does not need to ban silver exports. It only needs to control the licensing process. Approvals can slow, paperwork can stall, requirements can change. State-approved companies can prioritize domestic buyers. The valve can close incrementally without formal announcements. By the time markets realize supply is contracting, inventories have already drained. Consider what happens if China reduces exports by 50%. Not eliminates, just cuts in half. Global deficits exceed 5,000 metric tons annually. Industrial users scramble. Premiums explode. Some factories shut down waiting for metal. Others pay extortionate prices and pass costs to consumers. Products that require silver become unaffordable or unavailable. Supply chains fragment. Economic activity slows. That scenario is not speculative. It is mechanically plausible within the existing policy framework. Beijing has demonstrated willingness to use resource controls for strategic advantage. Rare earths prove the model works. Silver is far more strategic. It sits at the intersection of energy transition, technological competition, and monetary systems. Control over silver supply translates directly into leverage over economies dependent on those sectors. Financial markets are beginning to price this risk. Silver exchange-traded products absorbed 95 million ounces in the first half of 2025. Global holdings reached 1.13 billion ounces, just 7% below all-time peaks. Investors recognize structural scarcity. They are positioning for further price appreciation. But investor demand is secondary to industrial demand. When factories cannot source metal, the financial system's paper promises become irrelevant. COMEX, silver futures. Trade billions in notional value daily. Those contracts represent claims on physical metal. But COMEX warehouse stocks are finite. If industrial buyers demand physical delivery at scale, the exchange faces potential strain. Lease rates already spiked multiple times in 2025. That indicates tightness in physical markets. If stress intensifies, confidence in paper silver markets erodes. Premiums for physical metal separate further from futures prices. The pricing mechanism fractures. We have seen this pattern before in other commodities. When physical supply cannot meet derivative claims, markets break. Nickel markets on the London Metal Exchange collapsed in March 2022 when physical shortages triggered cascading margin calls. Trading halted, contracts were canceled, confidence shattered. Silver markets are not immune to similar dynamics if physical scarcity intensifies beyond what paper markets can accommodate. China's licensing regime creates asymmetric risk. Downside scenarios involve genuine supply disruption. Upside scenarios involve gradual adjustment and higher prices. The distribution is not balanced. The tail risk is severe. Industries face existential supply chain vulnerabilities. Financial markets face potential dislocation if physical and paper prices diverge. Governments face strategic dependencies they cannot resolve quickly. Beijing understands this asymmetry. The policy design reflects careful calculation. By controlling refined silver exports, China does not merely influence price. It controls industrial capacity in competing economies. Solar manufacturers in Europe cannot produce panels without silver. They cannot switch suppliers easily because 60 to 70% of supply flows through China. They either accept Beijing's terms or reduce production. That leverage extends across sectors. Electronics, automotive, defense, energy infrastructure, all dependent on silver, all now dependent on Chinese export licenses. The strategic value is immense. This is not about revenue from silver sales. This is about control over the technological and industrial base of rival powers. The United States and Europe are attempting to respond. The Defense Department invested $400 million in domestic rare earth processing. Similar investments are beginning for critical minerals, including silver. But capital alone cannot compress timelines. Geological surveys take years. Permitting processes extend further. Construction of mining and refining facilities requires additional years. Even aggressive policies will not produce meaningful new supply until the 2030 timeframe. Meanwhile, China is securing domestic supply for its own industrial needs. The licensing framework ensures state-approved companies prioritize internal demand. Chinese solar manufacturers get metal. Chinese EV producers get metal. Chinese electronics factories get metal. Foreign buyers compete for whatever remains after domestic needs are met. That is the explicit purpose of the policy. Domestic industrial advantage, global pricing power, strategic leverage. Industrial buyers outside China are quietly panicking. They are not discussing it publicly. Admitting supply chain vulnerability invites competitive disadvantage and shareholder lawsuits. But procurement teams are locking forward contracts at elevated prices. They are diversifying supplier relationships where possible. They are building strategic inventories. These are defensive moves indicating recognition that supply cannot be taken for granted. Some companies are exploring vertical integration, securing stakes in mining projects, investing in recycling infrastructure. These strategies require years and significant capital. They also assume available deposits exist outside Chinese control. Many silver deposits are polymetallic. Silver comes as byproduct of gold, lead, or zinc mining. Increasing silver output requires increasing production of those primary metals. Market dynamics for those metals do not necessarily align with silver demand. Supply response is constrained by complex geology and economics. Recycling offers some relief, but faces practical limits. Electronic waste contains silver, but collection rates are low. Processing is complex and energy intensive. Recovering silver from shredded circuit boards and components requires sophisticated infrastructure. That infrastructure is concentrated. Building new capacity takes time. Even if recycling doubles, it cannot offset a major supply disruption from Chinese export restrictions. The market is starting to understand silver is not just another commodity. It is a critical input that cannot be easily substituted or sourced elsewhere. It is under the control of a single nation pursuing strategic advantage, and that nation just implemented a licensing regime designed for maximum flexibility and leverage. Those watching closely recognize the pattern. Resource nationalism is accelerating. Countries are securing domestic supply of materials deemed strategic. China leads, but is not alone. Chile is nationalizing lithium production. Indonesia restricted nickel exports. Zimbabwe announced platinum export controls. The era of freely traded commodities flowing to highest bidders is ending. The era of strategic resource control is beginning. Silver sits at the center of this shift. It is monetary. It is industrial. It is irreplaceable in high-performance applications, and 60 to 70% of it now flows through Beijing's licensing framework. Industrial demand is not optional. Solar mandates are law in multiple countries. EV adoption targets are policy commitments. Data center expansion is driven by AI compute requirements that are reshaping entire economies. None of these sectors can function without silver. All of them now depend on Chinese export decisions. The supply deficit was already structural. 5 consecutive years of demand exceeding supply. Inventories drawn down across major vaulting centers. Physical premiums climbing. Lease rates spiking. The market was under stress before January 1st. China's export restrictions transformed stress into crisis. Some believe markets will adapt. They cite historical precedent. Commodities face shortages. Prices rise. Demand falls. Supply increases. Equilibrium restores. That logic assumes perfect information, rational actors, and no strategic interference. None of those assumptions hold when a major power weaponizes resource control for geopolitical advantage. Beijing is not trying to maximize revenue from silver exports. It is trying to maximize leverage over industries critical to economic and technological competition. Revenue is secondary. Control is primary. The licensing framework achieves control without overt confrontation. It is legal under international trade rules. It is defensible as environmental policy. It is devastatingly effective as strategic pressure. Western policymakers are slowly recognizing the trap. Designating silver as a critical mineral acknowledges the problem. It does not solve it. Building domestic supply chains requires years. Diversifying sources requires cooperation with resource-rich nations who may have their own strategic interests. Stockpiling requires physical metal that is already scarce. There are no easy solutions. Meanwhile, the clock is running. Solar installations continue. EV production ramps. Data centers expand. Every month, more silver gets locked into products with 20 to 30-year lifespans. That silver will not return to the market for decades. The available supply for new production shrinks continuously, and the valve controlling 60 to 70% of that supply is in Beijing's hands. Prices will rise. That is mechanical. When supply cannot meet demand, price must adjust until demand destruction occurs or new supply arrives. But price is not the only mechanism at play. Availability matters more than price when supply is gated by licensing. A manufacturer cannot produce solar panels at $100 per ounce silver if no silver is available at any price. This is the mechanism few are discussing publicly. Not shortage, not high prices, unavailability, controlled scarcity, strategic rationing. Beijing decides which buyers get metal. Foreign buyers compete for scraps after Chinese domestic needs are met. That is the world we entered January 1st. Those who understand supply chains see it clearly. Those who watch geopolitical maneuvering recognize the precedent. Those who track commodity flows see the inventories draining. The pieces are visible. The conclusion is uncomfortable. Silver supply is now a strategic weapon. And the weapon is deployed.